Yesterday we noted and discussed the occurrence of a bullish piercing candle on the market on the eve of the US presidential election results. Today, it is formally announced that Donald Trump will be the 47th US president, and the market has given a clear confirmation. In the trade session yesterday itself, we had noted the occurrence of a bullish piercing pattern with a high of 24,225, and we had further discussed that in order to factor any variances, we would keep a certain buffer zone, which in the video I had mentioned would be a third of the day's trading range, approximated to roughly 100 points, which would mean that we were mentally prepared that if the market opens or trades above 320, which is roughly 100 points above yesterday's close, we will take or initiate long positions. This would be because of the occurrence of a bullish piercing candle at range lows when the market is highly oversold, and we know that the structure is strongly bullish since this is the first monthly red candle that the market has formed in the last calendar year. We had discussed these points yesterday, and I believe that some have taken the input given very directly and initiated the trade at the open and benefited from the trade and have sent me messages saying thank you. The intention of the video was not to direct anyone into taking a particular trade. The idea of the video was to discuss the process of planning for a particular trade. And one of the rituals that many traders follow before initiating a trade is to articulate or justify the reason for taking that trade. And this process, because it is repetitive and has to be done routinely, is what makes trading interesting for traders. Your premise of entering a trade is solely going to be on the performance of your trading account. And I feel that if we combine the rules of money management that have been discussed in my previous videos with the technical confirmations that we are seeing, we would not only know when to enter and when to exit, but also know when to book out and how much to trade. So what was discussed yesterday was that there is technical justification for individuals who are trading the bullish piercing candle to trade in the long side upon the confirmation of the candle. And since practically when I was trading, I was also employed, often without an access to the market during live market hours, I would place buying stop loss orders at a certain level so that I would get initiated into the trade without the knowledge of the same. But that was back in 2015. Now things have changed quite a bit. One of the changes are the lot sizes. The lot sizes are so large that even defending a one-day candlestick is demands a lot of points, trading points. For example, had you entered at the exact confirmation, that was at roughly 320, and kept the stop loss that was discussed, the trade stop loss has to be governed by the low of the previous candlestick, and we would have to keep some buffer. So we know that the low of the previous candlestick is 23,850, and keeping a buffer of roughly 100 points, we would reach at a level of 23,750. So entering at 24,350 roughly with a stop loss of 23,750 is a 600 point stop loss. And with the current lot size of roughly 25, a 600 point stop loss will amount to rupees 15,000 risk on a single lot for the trade. And logically, if your stop loss is of 600 points, your targets will typically be larger. It could be 600 points, 900 points, 1,000 points, and so on. So how does one manage the trade given that each individual has different account sizes? And how does one enter? And this is the premise of the videos that I have created in the past and also with Upsurge, that your individual levels of entry will be governed by your account balance and your prior trading performance, while our exits are determined by the market. Since all of us are entering on a confirmation of a bullish piercing candle, a candle that was just formed yesterday, it is reasonable to at least have the low of that candle as the SL. Now the question is, when do we enter? Individuals who are working could enter at a given value, the case that I discussed earlier, that when I was employed, I wouldn't have access to the markets, and it might be the case with you. So we have no choice but to enter at a given value as a buying stop loss and take the higher risk that is required on a single trade. So this case, it would be a risk of roughly 600 points, that is approximately 15,000 rupees. But what if we were trading with what if we could not afford a risk of 15,000 rupees on a single trade? You have to note that we intend on taking hundreds, if not thousands of trades. So we have to be very careful of the value that we select. If your historic trade records are showing an average loss of 5,000 rupees, then you must plan your trades in accordance to 5 or 7,000 rupees based on your own trading records. So how would I use this information in combination with the money management rules that have already been set? As of today, we are seeing the confirmation on the market, and even yesterday when we were at this stage, we already knew that we would enter the market, or the market would suggest a bullish reversal if it trades 100 points above the previous day's close, therefore justifying entry. But what if we can only risk, say, 7,500 rupees? Then in such a case, while the trade is justified at the point of confirmation, since we can only risk 7,500 rupees, that's roughly 300 Nifty points, and we know that our stop loss is this pink line at roughly 23,750, we would put a stop loss, we will put our entry roughly 300 points above this, which would mean 2450. So I will just mark this here. With a green line. Now, what does it mean? It basically means that the trade has confirmed at 24,320, but since our money management only allows us to take a trade of risk 7,500 rupees, we will enter at 24,050. Now, one could argue that in this manner, that an individual with a larger account size or a greater risk appetite is at a disadvantage. But, and it is true, they are at a financially greater disadvantage, those who entered on the confirmation, because the stop loss is 600 points away, whereas you are planning, or someone else is planning, to enter after a correction, enter after a brief correction post the confirmation. So they would be entering 300 points lower. So wouldn't it be advantageous to them? And the answer is yes in that specific trade, no in the long term. And the reason is, a system's reliability is a function of the frequency of trades. Since the individual can afford to take 15,000 risk per trade per lot, such an individual will find many criterias and many reasons to participate in the market. And if such an individual is indeed profitable, then by running a profitable system multiple number of times, they earn far greater than individuals who are placing limit orders post confirmation, because the limit order post confirmation is also subject to the possibility of actually getting traded in that order. So the individual who has taken the 600 point stop loss has traded risk for certainty of the trade. And when we repeat this exercise over thousands of trades that we take over our trading journey, we begin to realize that there is a trade-off or a merit and a demerit in both the faculties. Now let's assume if I as an individual have a smaller account size and I don't wish to risk more than 5 or 10,000 rupees instead of 15,000 rupees, then how would I approach this process? Since I have got the confirmation based on today's closing, I know that I will be attempting alongside, and I also know that I would be defending 23,750. I would then, after this confirmation on the daily, shift my assessment to the hourly. I will remove this arrow, and in the hourly chart we will see the zones that we have marked out. We are seeing the price currently at the blue line, which is close to 24,500. We have also seen the confirmation at the black line, which is close to 24,325. We would have ideally liked to have entered at the confirmation itself, but since we cannot afford greater risk per lot, and since we need to take 2 lots in order to be able to book somewhere partially, we have a risk appetite which is slightly lesser on a per lot basis. Therefore, we will place a limit order at the green level that has been shown here, which is roughly 24,050. If my appetite of taking risk is roughly 10,000 rupees per trade, which would mean 400 points from the low, I would obviously shift my entry even higher and make it 24,150. Now, which is better? Entry at 24,150, entry at 24,50, or an individual who has already entered today? I will leave that up to you. What is good for you is to be able to enter only after you know where you are going to exit, and to be able to build up a position size which is consistent with your risk profile. And this is what I have learned, that when individuals who are trading are in the process of their trading journey from 1 lakh to 1 crore, there is a point in between where you will be at 5 lakh, 10 lakh, 25 lakh, and in each of these phases you can make significant mistakes in your trading career to send you back to the start. So it is very important for us to use technical analysis in order to make the plan, and money management in order to determine when do we enter or exit as per plan, the quantity. So the exit is given to us based on the confirmations and the candlesticks, etc. So the exits were already understood to us in our previous video when we saw the bullish piercing. We can see the oscillator. We can see how the oscillator has shown a significant divergence. We can also see that this confirmation has come on above average volumes. You can see that the green bar is slightly higher than the mean. There are many reasons to go long, but I would also in this video like to say that there are also many reasons to be short. From the perspective of a day trader, of a swing trader who is using the daily charts in order to determine the trend, such a trader is logically seeing that after the higher top, the market corrected, and at this zone here, I'm marking with 1, it formed a double bottom here. And after the creation of this double bottom, the market subsequently rallied a little higher and in the process created a lower top. And since then, the market has only been trading lower and in the process has created a lower bottom. Now you need to understand that a swing trader who's trading a single expiry is not going to evaluate everything that has happened in the past. Such a trader is going to look at short-term price actions to determine the direction he or she needs to take. And such a trader is seeing a market that is creating a lower top, lower bottom structure. And such a trader, in his or her senses, is very reasonable to make a sell attempt at the market with a stop loss of around 24,900, which has been marked here, which is the high of this candlestick here. Because we know that the previous support zone, that is the zone of the double bottom, will now be the resistance zone. So such a trader could be gradually building up positions as the market moves up till here, in the anticipation that after it has done this, the market could potentially either test this zone and create a double bottom. It could either do that, or the market could continue the rally further and create a lower bottom, at which point this trader is sitting at potential windfall gains. So there are both sides that one has to assess before taking up trade positions. One must understand that in a video, if a confirmation is given, we are talking about an academic confirmation, and the trade that you take is largely driven by the account size that you're managing, the general system accuracy that you have experienced in the past as a trader, and how much risk are you willing to take on a single position. I hope that today's video has been insightful, in that we do use technical analysis to plan the trade. We do use technical analysis to determine when to exit the trade, but we do not use technical analysis to say that now that there is a bullish piercing candle which is confirmed with higher than average volume, the market has to rally. We do not make these statements. Not even generally, and definitely not in our heads, because if we make such statements, you will have the potential of over leveraging. We are just seeing a simple candlestick pattern which the market is going to create hundreds if not thousands of times, and such a pattern could work 10 times in a row, could fail 10 times in a row. Such a pattern has its own profile, and we are just trading that particular profile, open to both possibilities in the market. Our entries need to be a function of the lot size and the risk that we are taking. Very small accounts, you will note, who can only take 1000 rupees risk per trade on a Nifty lot of 25, that is just a 40 point SL, which would mean that if our stop loss was say 23,750, the entry can now only be at 23,800, which is very close to the low. Now such a trader is risking very less, but the trade span is going to be very small, very short. The probability of the trade occurring is very low. Such a trader could get whipsawed very often. So these are the costs of taking a very low risk on a particular trade, that your experience in the trade is very uncomfortable. Whereas a trader who entered at a clear confirmation with a deep stop loss already has a long position and knows that a bullish piercing candle at range lows could potentially make him or her serious money, and if not, the loss is already known. With this information, hopefully we will take trading decisions which are more suited to our account size, and periodically discuss a few concepts as and when they play out in the live market. I wish you well.